of what kind of challenges or what assumptions or how the workings for a brand and the customer relationship valuation needs to be done. So just starting with brand, so I'll need some interaction from your end also. So when you hear the word brand, what kind of thoughts or what kind of views come to your mind, if anyone could answer that?
Credibility of the say Tatas, then we create something. Yes, this Reliance, future brand. So we come some sort of comfort.
So more referring to the trust part of it. That if you see a big good brand, you get more comfort, more trust on it. Okay, great. Anything else?
Value addition has some company which have a value addition.
Okay, so company where they've been doing some kind of a value addition since past so many years have created a brand for themselves.
Yes,
okay.
Reliability.
Reliability, great. Okay.
And
like creativity, innovative, like Apollo brand. Apple. It has every year it has some changes in the brand value. So we prefer to buy the Apple mobile.
It's pride.
Prestige,
great. So a lot of I see operations or processes of the business are being related ultimately to the brand, and that's how the brand is created over a lifetime of a company. That whatever things they do, may it be processes, may it be marketing efforts, may it be building the trust of the customer, everything at the end relates to the brand, and that's why brand becomes a very important asset for a company. So taking this forward, B2C and B2B, these are very two key terms used to differentiate the businesses. Where I'm sure you are aware of both the terms, like B2C is direct to customer and B2B is business to business sales. So can anyone just tell me these three logos that I have put up here? What is the first logo for?
yes,
Apple,
right? And second one?
McDonald's,
Great. And third one?
Mercedes.
Audi. One is Audi. But yeah,
Audi.
many of you guessed it right. So the crux, see, without even having a name, all these three logos are built in our mind, and that is because of the brand value that they have created in our mind, right? There's no.
I understood. So which means it is falling with 20 to 23. But how did it? Is it dated?
Now on the other part, there are three brands where you will see these are three brands related to a B2B kind of a business. But do you see a big gap in both the logos of B2C versus B2B companies? In B2C, there is no requirement to write their name along with their logo, whereas in B2B, everywhere their name is mentioned, and this I have seen for a lot many examples. While it will be not true for all of them, but maximum of them. So what does this imply? What do you think this ultimately implies to?
The audience is different, right?
Okay, the audience is different. I mean, my question is being why B2C companies need not have their name attached to their logo, whereas for B2B it's almost kind of a necessity.
B2B don't invest so much on brand promotion, like running ads.
Okay, great answer. Yeah.
So B2C is for the masses actually. B2C is for the masses, correct? So they just want to make sure that once a person identifies a particular design or a logo or something, they relate to the company. Whereas here you are approaching customers. The customers, you need to let them know their name, who they are dealing with. So that's why that name and the logo comes here. That's what I would think.
No, they want to.
B2C is where,
Sorry.
Hello? B2C is where you can create customers' loyalty. So brand makes a, great impact in making customers loyal. Whereas in B2B, it is not much of the, customers' loyalty is there.
In B2C, decision making is mostly by
B2B branding,
human
B2B
beings,
branding is
and that decision making may be a little more based on emotion. In B2B, typically decision making will be done by as a part of a decision making process inside a corporate. It will be more rational, relatively speaking.
In
Okay.
in a B2B, what happens is essentially whatever the service offering you are providing, it has to be it needs to be communicated in through their whatever logo or through their brand name. The service offering, like consultancy is a service offering or a sales for the service offering. The attempt is to communicate the service offering in a B2B. In a B2C is largely a product oriented. So therefore, you may not have this service offering. It's more you associate a product.
Actually, what I can see here is we are talking about two things here. One is brand and logo. So logo per se, if we see, it will be more important and it has to be designed in a little bit different manner in B2C, and B2B, the approach will be different. So as far as branding is concerned, I think B2B branding is more from not only from customer perspective, from also from employee perspective, because they also have to do employee attraction, and also they have to it's overall corporate branding which matters actually.
Yeah, I think so. I think you all have covered, the differentiation or the relevance or the importance in some or the other manner where, they want to create visibility, or it's for the masses, or it's going to be creative. So these are all the correct examples. So now if I have to ask you one simple question that, if say there are two companies, say Audi and TCS, for example, and everything, all financial parameters are same, everything being same, which company will have a greater brand value?
B2C.
B2C, correct. So that's what I wanted to imply, that B2C brands are basically something which have a greater brand value if compared with B2B, and this will ultimately help us in the valuation of brand. Now coming to the the third critical thing for brand is whether we take a perpetual life for a brand or a limited life. So any thoughts, when we can take perpetual life for a brand?
I thought it is always a limited life.
Yeah, I don't think brand would have a perpetual life. I don't think so.
Okay.
Agreed. Brand is has a limited.
Okay. So for example, here in, say we take an example of McDonald's. Okay. Now tell me, see, as a entity or as a business, we always consider it as a going concern to be there for perpetual, right? Now, if I say that McDonald's, the brand itself is not there, then what will you say? The business also gets impacted to a significant extent. So in this kind of a scenario, where we are saying a business having a perpetual life, which is run, whole and soul core by the brand value that it has created, then why can't have a brand have a perpetual kind of a life? So in practice, and this I'm saying by a lot of PPAs that are there, that are being already done, we can have a perpetual life also for a brand, and we can have a limited life also for a brand. Now the decision making, whether we go for a perpetual life or a limited life, is dependent on various factors, such as firstly, B2B, B2C is one of the key factors. B2B, it becomes very difficult to defend that it can have a perpetual kind of a life for it, unless there are very strong brands attached to it. The other factors that will be relevant is how stable or established the brand is. The industry in which the company operates is also very much relevant for a brand. So say if, for example, stationery items are also a B2C component. But when we go and buy a stationery item, we are not so much concerned about the brand of it. So, it's not necessarily that if it's something B2C, for sure it has to have a perpetual life. So we have to look into the relevance, importance of, the brand that we are valuing to ultimately determine whether a perpetual life will be correct or we take a limited life, 5 years, 10 years, 15 years, longer life. So while I see, many of you had, the view that it should always be limited life. So I would like, if anyone has further questions, if we want to discuss on this point, we can still discuss.
I think interesting observations you said. So whether we assign a BlackBerry today also a value, the question that we need to answer is, whenever we take a perpetual, what is the value we associated? If you are associating a high value to the brand, that will be only for the limited portion. Thereafter, the value associated with the remaining years, in terms of probably a eyeball connect or a brand awareness, probably that value comes in the remaining life. So if the eyeball connect or the brand, for example, today we'll all know Renault pen, who have been in 30 years back, which was very aggressive Renault, but we still know the name. But whether that will help, that will make us decision making to purchase or pay premium, probably not.
Yeah, because Renault has always, branded its pen as, for the masses, right? So coming to the example of, also BlackBerry that you mentioned, BlackBerry, if we see, it made a huge growth from 1994 to 2000s in a small span of time because of the creativity that they had brought in, and that what created a brand value. Now, at that point of time, anyone valuing a BlackBerry brand will have to keep in mind that this is just a small spike which has happened because of one of their key, innovations or creativity in the products, and then have to decide whether we take a perpetual or limited life. So, the factors, the relevance has to be brought into picture when deciding for a perpetual limited. Yeah, any other questions on this point?
Yeah, but the thing is, see, we can't predict the market, isn't it? So maybe today, today there is nobody, because Apple is more of a proprietary and today there is nobody else, but tomorrow somebody else can come. But whether he will come tomorrow or day after tomorrow or after a year or 5 years, that is something which nobody knows. So in that case, at this point of time, only criteria that we have on a perpetual and a limited life is basically the competitor. If as of now, if you don't have a real competitor, probably we can think perpetual, but I don't think there is anything like perpetual in terms of brand, isn't it? So in that case, how do you actually decide whether it's a perpetual or limited life? And if it is perpetual, how long? These are all completely, it's an assumption, isn't it?
So definitely, sir, so first of all, the classification has to be made between perpetual and limited life. If you are assuming perpetual, then there is no question. We just have to take a terminal year assumption for that, right? So, and now just coming to how to determine if it's perpetual. So one of the very interesting point that you mentioned is, is it kind of a monopoly or a duopoly kind of a scenario? So, Apple, Google, all players being there. So for them, we can easily take the assumption considering the today's scenario. And as you rightly mentioned, we don't know what's going to be 15 years, 10 years hence. But valuation, when we do, it's always basis the practice at today's point of time. So if today we have strong basis to say that, there are no competitors to Apple, Apple has created such a huge significant brand value for itself that it will last for a very, very long period of time. And basically it is a stable kind of a scenario where, it's not something which has just come up for the last 5 years, made a huge, impact in the market. Everyone knows about it, but it's something which is very stable, been there for so many years. And that's what creates a perception in the mind of people that it will continue to be there for so many years. So you can take, a lot of FMCG examples in Indian market, like say Dabur, Britannia, Nestle, right? They've been there for so many years, like years and years. Tata being one of the premier, groups who have been there for more than 100 years. So if something has been there for so many years, right now, just because we are doing a valuation exercise and we say that, we take a limited life of 15 years, won't make sense, right? So if there are bases for us to take a perpetual life, we should definitely go ahead with that. Yeah.
One question. So even if you take a perpetual life, for calculating the terminal value, you never take the growth rate higher than that of the country or whatever,
Correct. Those are the assumptions, sir. Yes.
Correct. So does it make so much of a difference if somebody takes 15 years and you're then assuming perpetual life, you take a growth rate which is very much lower, the GDP growth rate. So India's GDP is 7%, 8% now, but if you take terminal value, you take it much lower. Doesn't make so much of a difference.
So, sir, in the calculation, if generally, even if we take a limited life for a strong brand, we would tend to choose a 15-year kind of a life or a 20-year kind of a life. And if you do the actual maths, it won't make an impact. But see, ultimately, if this exercise entirely solely being done for a PPA purpose, which finally is being used for accounting, right? So for company, it becomes a very critical aspect, because if you're using a perpetual life in your brand valuation, then you have to do an impairment testing every year. But if you are using a limited life, it's an amortization method, right? For the for depreciation, which directly impacts that P&L. So many times we will come in such a scenario where the company is hard pressing on perpetual or a limited life, but we as a valuer need to have our basis strong on whatever call we are taking ultimately.
But what will the GDP growth, what we are referring to a terminal value, does it refer to the revenue side or to the profitability side? I presume brands give higher profitability, right? Revenues being constant.
So, sir, we will come. I have an example for brand valuation also, where I have taken a terminal one example, because limited life is pretty simpler in that manner. When
I'm not talking to that. I'm only asking clarification, because I think one of our fellow colleagues has asked, and it's an interesting question. I'm assuming a terminal value you are tending towards GDP growth rate. Would this impact the brand value? Because I'm assuming that is on the revenue side, but the brands may give a higher margin even though the revenue is being tending towards the GDP growth.
So, sir, like we do for
just to interject here, if you assume that the either the profit or the sales grows higher than the rest of the industry, what it means at infinite level, it will have 100% of the profits. That is why you do not assume higher, because that means this company is growing while all the other companies are stagnating or whatever, which means it will go to a very, very high level, which realistically is not possible. There is at some time that gravity pulls in and all companies decline. So even when you take profits, you moderate that to much lower than what it is currently. And generally, even there, I would say that after all, you start with free cash flow. You say the free cash flow is growing at such a rate, and then you say that it cannot grow more than GDP, because then this company, you can't have a company which is 80% of GDP, right? After whatever 300 years, when you're talking of perpetuity or whatever. So the theoretical thing is that the basis of moderating it is that.
Actually, only thing is the present value has insignificant impact, even though you take a little higher. Irrespective, I think that's a different discussion, but understandable. We can proceed further.
Okay, great.
Hello, Pruthvi, just one question. So you said that for a B2B business, brand is of a lesser relevance. So can you highlight scenarios wherein for a B2B business, you will identify brand as an asset for PPA exercise? In which scenarios you will identify brand name for a B2B business?
No, so see, if ultimately the brand is such where people are able in the industry are able to recognize it with their name itself, right? So you will definitely go on to identify it, right? So for example, all the three brands mentioned out here, you are able to identify them with their name itself, right? That okay, if I am giving some assignment to TCS on a B2B basis, they'll be doing a good job because TCS as a name, as a brand has created that value, So you go on to recognize it. Likewise, in every industry, so these are very famous names, but you go in every industry, just you need to dig it little deeper that, basic things that you can do is, say, for example, you are given some assignment in, say mining industry. So you just go on Google and try, type out that, okay, if it's in Australia, top 10 mining industries or top 50 mining industry in Australia. If there is a recognition to that brand and if the name is appearing, okay, this is just one of the various, tests that we can do. But if there is some kind of a recognition to that brand, you can go on to identify it. But ultimately, the value of the brand for a B2B in most of the scenarios will be comparatively very low than as compared to a B2C scenario. So, Shujan, have
Understood.
I answered your question? Yeah.
Understood. Yes.
Great. So now we move on to, how do we actually value the brand? Okay. So while, you mentioned a lot of relevance and thoughts on brand, but one key aspect, which comes to our mind at the very first instance when we say brand, that if, say, for example, if someone does not have a brand and I am taking it on a franchise basis using their brand name, then what's the first thing that comes to your mind?
Royalty.
Correct. So royalty is the pretty much, word with all of us could relate to brand. So from a methodology perspective, the most used method for brand valuation is a RFR relief from royalty method. Now, apart from that, what I have seen in some of the cases, people also using excess earnings method, which, is used in case brand is the core, whole and heart of the business. That without brand, the business cannot do anything. If that is the scenario, people have gone on to use excess earnings method also for valuation. Now, and then a lot of them, what they do is, while RFR is the most preferred method, excess earnings is used as a corroborative or an additional check to see that, okay, the values are within a range, or, the RFR method is not throwing something very, outlier side. So these are the two most used method for brand valuation. Right now, I am covering the RFR method. Excess earnings method I am taking on for a customer relationship. So we'll cover that. Now, the core part, as you mentioned, royalty is something which relates to brand. So if we have to find the royalty rate, what royalty rate should be applicable for our brand? What do you think, what are the, and if, say, for example, I give you a set of 20 transactions in the past where some royalty has been charged by company A to company B, and now you guys have to select, okay, which is relevant for us. So what are the factors that you will look into while selecting the, relevant royalty rates?
Type of industry.
Okay.
Number of transactions.
That is to say that, how many, like mean, median, what you want to use based on number of transactions. Fine.
Software, or it is based or consumer based.
Okay, so we need to think of filters, I would say, which are available for, so say which are basically available for comparable transactions also. So what are other things, say I'm taking a franchise for a FMCG product, and it's a 5-year franchise. So what things, if I have to determine how much royalty I'll pay to them, what should I consider? And I have a set of 20 transactions. Say.
Life of the asset.
Life of the okay, tenure of the agreement.
Brand. Yeah.
Okay.
I think market size is one factor.
Okay, I think, yeah, there's some point which is very closely related to the market size. Yeah, but
so the premium that products of this brand fetch over other companies, that differential would be important.
Correct. So that's one more qualitative aspect when selecting. Okay.
The product margin which is expected.
That is little difficult to get for comparable transactions. While I agree that that is relevant, but the database or the public data doesn't throw that kind of a granular data. Okay.
For royalty industry standard, no? What is the particular industry? Is it engineering industry, automobile, software industry? So I think that will benchmark.
Yeah, that can be a benchmark for what kind of margins you can earn on a stable state scenario. But here we have a set of 20 transactions and we have to select from that. Okay.
Recent, which is recent.
Okay, that's definitely one where we screen. So few of them, which the key ones that I found it very relevant, and you have added a few of them here definitely. So one is when you start screening for royalty rates, the core thing you have to look at that it's only for brand. Okay, lot of agreements have collected assets together like brand, IP, technology, and all of three have been given on franchise or license basis, and a rate is charged. But you have to select transactions only where brand as a standalone assets has been given on a license basis. Second is the geography. Okay, whether the license is given for any specific geography like India, Asia, or it's global. So that is kind of a comparison that you have to do. Third is the tenure, whether it's like a short term in nature, 5 years kind of a license, or it's a perpetual license or a longer tenure. Then next comes exclusivity, that whether only you will be able to use this brand in the market, or they have tied up with 3 other players also to use it. Next is, because we'll be using ultimately this for a calculation, the base of royalty rate, whether the royalty in the comparable transaction is paid on as a percentage of sales, as a percentage of profit, that need to be segregated. So these are the very key ones, apart from any additional data. And as you guys mentioned few of the pointers, if we are able to get such kind of a data, definitely we can use it. Now what practically I have been asked a lot of times is, from where do we get this data is the biggest challenge. Now finding these data points by doing a Google search is very difficult. We don't get a qualitative data, a qualitative output ultimately. So there are databases which we should try and use to get this. So these are some 4 or 5 databases which I have been using on a regular basis. These are all paid database, and it's not like we need to have a subscription for this. We can use this on an assignment to assignment basis. Right. So I will just take you all through one example of royalty source, that how generally we do a screening for this. So I go on the website. Just go, let's get started, and then we are valuing say brand here, and we describe that okay, in what industry.
You have to share your other screen also, because we're only seeing your slide.
No, it's not visible.
No, it's not visible.
Oh, sorry. I shared my entire screen only. 1 second. Let me just reshare.
Okay, Markables is a free website. Markables.
No, none of them is free, sir. None of them is free. Just tell me if you are able to see. So the presentation you'll be able to see, but I'm just going on the website. Are you able to see my Google page?
Yes. Yeah, now we can.
Okay.
Yes, sir.
Thanks. So royalty source is one of the sites. If I just go on get started, these are the options, basically what type of agreements we are searching for. So ours is a brand, so I select brand. We have to describe, the industry or the business of target. So right now I'm just mentioning FMCG, but we need to just explain in 1 or 2 liners more. What does your project relate to? Say PPA. Give your email ID here, and any specific comment that any specific inclusions that you would like to mention here? I agree. And next. So once you submit this, what royalty source will do is they will send you a list of say 50 or 100 agreements in their database with a brief description in that, what does the business of that agreement relates to. Then after that, you have to select, say, how many ever you find relevant, 15, 20, 25 agreements, and submit them to ask for the royalty rates for each of them. And that's when, they give you a detailed information for all of the agreements, and they have a pricing mentioned here that, is dependent on whether you want 10 agreements, 20 agreements, 50 agreements, etc. So all of these websites have a similar kind of, arrangement. And I'll just show you the kind of output basically that is thrown ultimately when you select the agreements, right? So they give you all these data that, what is the unique code, what is the type of asset, licensor, licensee, what is the description of the object, exactly which industry they were in, what is the geography, when was the agreement entered, duration, and ultimately the last thing that we need is the royalty rate for this. So the compensation will have, what kind of a royalty was charged. And from here, we have to extract the royalty rates. So, in this case, for example, 10% of the gross revenues. So that will become our base. So this is how, we have been screening and this gives a lot of credibility to our work. Of course, many a times the clients have come out saying that this is getting a little expensive. But we need to just try and push them because ultimately, this gives a very qualitative output to our work. Apart from this, if we don't have that kind of a budget from the client, then the only way left out is to do a Google search, try and find out the transactions where the royalties, have been charged. And most probably we need to then find out US companies, because only in US companies we can easily access their SEC filings, right? So we can get the financials from SEC and we read through their financials and try and extract the royalty rates. So that is the only way out, but that is, very difficult. We don't get much of a qualitative data from them.
Could you please take us through one of them?
For what?
Through the Google and the editor SEC filings.
SEC filings, I can show you, how to get on the financials, and then basically we just have to do a normal search of royalty as a control F search and try and look, if anything is reported on the royalty front by the company. So that's why it's a very time consuming and a tedious process because whether we will get a kind of output, we are not sure of. So, there's no, while they have a word, but there's no royalty. So going to the financials is very simple. You just go on the SEC website, type the name of the US entity. Okay. And you go to the 10K form. This is the annual report. Like in India, we have the annual report. This is the detailed one. You will get all years annual report here. Open it and do a control F royalty.
Okay.
So that's how you find it. So very time consuming process. But yeah, I mean, this is the another alternative we have. And see, overall, some of you guys may have read it, that there is a thumb rule which is applicable for, a royalty kind of a scenario, which is, 25% of EBITDA margin or operating profits, basically, as that's what it's called. And recently, in a very interesting, judgment, it has been accepted as a corroborative check also, which was a little surprising that, this, because a detailed study was undertaken by some expert and all. So when you ultimately get a royalty rate, and you want to check whether this is reasonable or not, the output, we do a 25% operating profit check, that if our margin is say 20%, 1/4 of that, 25% of that will be 4%. So if we have a royalty rate around that, that's something, which is an additional check. Not necessarily, it will be true in all scenarios, but in most of them, it definitely works.
25% of EBITDA.
Of, yeah, EBITDA.
Okay. Could you please tell what are generally the charges for the getting royalty rates?
I'll just go to say, for example, royalty source. So for up to 10 transaction, it goes up to $425, which is roughly around 35,000, I think.
Okay.
Right. And for every additional 10, it's $50.
Okay.
So everyone will have, I think, a similar kind of thing. And few of the websites, I think Royalty Range, have an annual subscription service. So if you are doing this kind of an assignment on a very recurring basis, then an annual subscription will be much cheaper compared to this, on a per assignment basis.
Have you taken annual subscription, Mr. Pruthvi?
I have taken for royalty range. So this output that I showed you is a royalty range output only.
Royalty range.
Yeah, royalty range.
Can you show once royalty range? Can any of our members approach you for this, of course, at a cost? Mr. Pruthvi?
Sorry?
Can any of our members approach you to get this information, of course, at a cost?
Definitely. I mean, cost is not an issue, but I mean, that's okay. But we'll have to find out a way to share. How do we share this kind of info? Because over email it gets a little tricky because of the very strict regulations that they have.
Okay.
Yeah.
What is the annual subscription charge, sir? What is the annual subscription charge for this?
I will have to, because see, I don't deal with the recurring subscriptions for and all. The team does this job, and I don't even have my own login ID password, because this all things have been done by my team. But what I'll do is I will check it once. See, I think they have a service fee also here. I will just check this, that what are the rates and all for this, and get back to you for an annual subscription.
Sure.
Okay.
Yeah, so that thing I'll definitely get back. Okay, just going on to our next. So this is how royalty rate based brand valuation will look like. I have used revenue as a base because that's what we get generally most of the royalty rates for. This is nothing but the revenues that we project. So like we project revenues for a business valuation, this is something which is attached to the brand that we are valuing. And generally, if company has only one brand, then this is nothing but the business projections revenue itself. Okay, for a period of, say, if you are looking for a terminal life, we generally look at 5-7 years kind of a scenario. This is pretty similar to the assumptions for a business valuation, about what all factors we use in determining the explicit period and the terminal growth rate. Similar case we will use out here. 4% is the royalty rate of revenue. So you multiply the revenues by 4%. We reduce the taxes because ultimately, if we are paying royalty to someone, we will have a tax benefit on it. So because we are owning a brand, this is the net savings that we are doing on a royalty. The last year will be capitalized exactly similar to the business valuation. So terminal value divided by K minus G or VAT minus G.
Prithviji?
Yes.
Not sure if you covered, but the discount rate of 20%, anything specific significance to this brand value?
I will just discuss the key things that we should keep in mind when determining the discount rate for brand. So I'll just come.
Sure.
Yeah. So this is the terminal value like we do for a normal business valuation, multiplied by the present value factor, and we add a tax amortization benefit. So I'll cover this also in my last slide as just a very brief concept. How to do it in detail, it will take a session again. So now coming to,
1 minute. Yeah. Hello.
Yes, sir.
Markables.net database can be searched for free. For searching database, we did not pay anything.
So what Markables I think does is Markables will give you the list that so here royalty source you have to submit, right? What kind of a valuation you are doing, and then they will send you a list of transactions from where you have to select it. I think Markables has that kind of a transaction ready, but it will not give you a royalty rate. So the output will be given only when you pay that.
Royalty rate, what it gives actually, I have searched it for some assignment regarding some jewelry business. Now they have given some international benchmark for companies in USA, UK. That what is the royalty rate? I cannot disclose the name of the assignment, but
No, sorry, who has given the benchmark, sir?
Markables.
Markables directly.
Company wise, the name of the company was there. What is their royalty range? The band. It was given 2% to 4%, something like that. That they have given.
So I think what they give is 5% and sub, 5% and above. But that will not help you to give arrive at the ultimate outcome, right? You need the royalty rate exactly what is there.
Okay.
Yeah. Because no one, they have the pricing tag here also, so
pricing tag
they have mentioned searching our database is free. Upon pay of the selection in your basket, they will give you the final results for it.
Yeah, searching database is free. Yeah.
Yes, correct.
Is it $30 for 10 files, sir?
No, per $300 it will come to.
Markables.
Yeah, 30 for one record.
Oh, so you can only. How is it if you just select one, then you just have to pay $30, is it?
Yes. So number of records 1 to 10. If you are selecting 5, then 5 into 30. If it's more, then the less price.
Got it.
So this, all the 4 websites, you can see the pricing and then decide. No. Yeah. Okay. So now coming to the key, so all other aspects, are pretty much either the data provided by the management or the royalty rate we have searched. The discounting factor is the one thing where we need to be a little careful of. So from a discounting factor perspective, we all calculate WACC for our businesses, cost of equity for our businesses. That's the starting point, and that's how we will do for intangible valuation also. Now, any thoughts, for brand, whether our rate should be higher than WACC cost of equity, lower than WACC cost of equity, or it can be anything, doesn't matter.
Higher. Due to intangible asset, it should be higher.
So I think pretty simple, because intangible are the most riskiest one, right? You don't have any tangible for it. So it has to be 100% higher than WACC. Now, higher than cost of equity or not, there is some debate in the industry. My personal opinion is it has to be higher than cost of equity also. The simple reason being, in the past, we have seen few examples, say with the very famous Kingfisher one, where they took a loan on their brand value, right? But after that, banks have stopped giving loan on even brand as an intangible, or for that matter, any intangible asset. If you go and tell the bank, I have this intangible, they've stopped giving loans on that front. So which easily means that you have to fund any intangible assets of your own equity, right? And because they are riskier in nature, my personal opinion is their discounting factor should be higher than the cost of equity also. Now, how much higher, that is something as a valuer, it's our assumption. But in the industry, I have seen people taking WACC as a benchmark and applying a premium to that also.
Prithvi,
yes, sir.
Which means today, if Apple, Tata, Reliance, if they go and they want to do funding based on brand, now because of the Kingfisher story, They will
Yes.
not be able to fund the basis brand. Is that what you're
Correct.
saying?
Yes, yes. Banks have been very reluctant. However, what names we are speaking are very selected, few ones having, a presence which not even, 99% of other companies will demand. So maybe, for instance, Tata might get it, but when we are doing a valuation, for a company with not that kind of a history, not that well established, not that strong presence, banks don't give loans now.
Okay, so understood. So one thing is clear that the discount rate should be higher than the WAC or COE.
Yes.
But can you help to understand how should we arrive at the discount rate? Or maybe if you're covering that in the other slides?
WAC I am not covering, but if you want, WAC is the basic business
No,
valuation.
WAC is fine. I understand the concept. I'm talking about specific to the brand. Let's say if there are two different brands,
Correct.
right, within one company. So how will I arrive at a discount rate if I'm valuing a specific brand? That is what my question is.
So this premium on WAC or cost of equity is very much on the assumption. So like, while arriving at the cost of equity, there is a concept of company specific risk premium, where we look at, factors that, how riskier the business is, the projections is, how the company has done in the past, etc. So we have to take assessment of, the brand presence, since how many years the brand is present. What is the visibility of the brand or the trust of the brand in general? People have, Tata versus Reliance. So Tata as a brand will be less riskier because of the trust that people have over them, right? So it's very much subjective in nature, and as a valuer, we have to consider whether we want to add a 1%, 2%, 3% premium or a WACC cost of equity kind of a scenario. So there is no mathematical or a scientific formula to arrive at. It's similar to a risk premium that we generally add in our COE calculation.
One connected question that I have to whatever question that was being asked, whether basis this banks are not giving loans. I think, is that a feature only in India, or it's world over? The banks have learned a lesson because of Kingfisher and they are now refusing to give loans. Could you give any inputs on that?
Yeah, so I think generally also globally they were reluctant. India was one of scenarios where they had gone ahead, and what all would have gone in obtaining loan against a brand or any intangible. Let's not get over that. But yeah, generally there has been a reluctance, and especially after Kingfisher, it has increased a lot.
I have a counter question.
Right now, yes. Sorry, just one more point on this. So while brand is something which we are still able to relate to very closely, right? But if we are say talking of intangible assets like say know-how or processes, right? Now that is 110% sure that bank is not going to give any loan for a know-how or a process. Brand is something which actually can be related to somewhat. So few of them might go on for a Tata Reliance kind of a scenario, right? But if you are talking on intangible assets in general, then definitely other intangibles very next to impossible kind of a scenario. Yes, Ganeshji. Hello.
Yeah. Hello.
Yes, sir.
No, I'll call back. So sorry, I just wanted to ask a different question. Yeah. Essentially, the question stands is, you said brand is riskier, and I also personally believe that there should be higher on equity cost, higher than the cost of equity. But what say the brand gives me certainty of higher margins. Brand gives reasonably certainty of more number of customers probably purchasing from me. Therefore, purely from a brand perspective, it should be cheaper, right? Because there's less of a risk than otherwise.
So, sir, it will be cheaper than, for example, say a customer relationship. So, if from an assessment perspective, if you are valuing 3 intangible assets and you want to assess that for brand, how much I should consider, for customer relationship, how much I should consider, you can take a call that if brand has a good, trust, reliance, stability, then you add a lower premium to that. But if you are, say, comparing it with any tangible assets, current assets of the company, then I mean, it can't be cheaper than that, right? Because there is something tangible, you can just go on the market and sell it off.
I'll give just, I mean, it's a hypothetical question, and I'm sure I think it's for all of us. Let's take Nokia as an example. Nokia. Nokia as a company is bad in execution, or even say Kodak, when it was bad in execution and company was in bad. So if I'm valuing the company, I would actually value it less because it is impacting me. The company is going down. A lot of other risks of the company's operations come into picture.
Right.
But if I segregate Kodak as a brand name and say that value my Kodak, that has a certainty of getting certain customers, that has a certainty of getting higher margins purely on the brand name.
Yes.
It has no risks of the operation mismanagement of other things that the company is associated with.
Hello, Dada.
So, sir, for see,
अच्छा,
so just to,
आज क्लास है?
Saurabh ji, can you just
7 पे है. Okay.
go on mute?
Then.
Yeah, thank you. So yes. So on this point, while what I understand where you are coming from and what you are referring to, but ultimately, sir, when you are valuing brand and taking a stream of revenue, now to achieve that kind of a revenue, you will need to have various assets and liabilities in your balance sheet. Now, what we are referring to, business as a whole, consists of what? Basically, your assets and liabilities. Now, there are tangible working capital assets, intangible assets, right? And this ultimately comprises of your business. And then there is goodwill left out, right? So now, if you are saying that entirely combined, business has a WACC expectation of say 15%, and now I have to divide that 15% between all of my assets, that how much return which asset is going to give, right? So what you are trying to say is, maybe if Kodak would not have been there, this same business would have asked a 18 or a 20% return, but because of Kodak being there, this is giving me a 15% risk kind of a discounting factor, right? But of this 15%, if I have to allocate it within various assets, 15% is the WACC now I have arrived for this business. And if I have to allocate it to various assets, so tangible and current assets will definitely gain a lower one, right? Because these are something which are tangible and you can see, feel, and sell it off, right? And within this, brand will have a higher. So ultimately, you have to arrive at a 15%, right? What you are referring to is something which is, say, non-branded, and I have to, it does not have anything, versus what I have a Kodak as a brand and it will help me sell off. My overall business risk goes down there.
Yeah, I said intuitively we all know that intangibles should be higher cost. I was just referring, let's take someone like the brand BlackBerry as an example. So the traditional notion of intangible means higher cost, because traditionally when you are not able to touch it or feel it or something, historically prior to 1990s, we could understand that the value that your expected return is higher. But today, globally also, the percentage of intangible assets in the books of overall assets is very high. And people are saying that is not riskier. The other things could be of risk. For example, I'll give another example. You have a global operations. The entire global operations in one part of the Middle East or some other places, it has gone to bad weather because of the macro environment. But the brand name is good. So would I value what? So the branding that this will always be higher is something I'm not sure whether it is right or wrong.
What I'm trying to say here, sir, is that because you have a better brand, your operations though have gone bad, but because you have a brand, your business risk, WACC, basically when you're determining the WACC, that itself will come down, right? But when you're trying to allocate this WACC to various kind of an asset, of that brand will definitely gain a, ask for a higher return.
Okay, sir.
Yeah. Okay.
We'll still explore. Yes, sir.
Sure. Okay. So this is on now. Ultimately, this 4% royalty rate. This is how I'm just showing you how we need to just present it in a report kind of a format. This is the basic data that we ideally give in a report that how we have arrived at the royalty rate. And ultimately, other write-ups which we should have as a standard practice is, in brand, what is the importance of the brand and use of the brand to our business. Then for useful life, perpetual or 5-year, 10-year, 15-year, we need to have some kind of, a write-up that how we have decided on the life, what factor we considered. Then just mentioning the approaches, finally, what we have considered. And if we are using, say, relief from royalty, just explain either the method or the key steps of relief from royalty. So just, as a report format, this is how, if we are able to show, might look in more presentable manner. And with this, the prior formats of, this table and the RFR rate assumption. This would almost sum up a brand valuation section in a PPA exercise.
Pruthvi, are we supposed to adjust any brand building expenses for the forecasted period?
Excellent question, and this is where again the industry is having two views, in the sense, if your brand is a growing brand and you are still recognizing it, then definitely you need to adjust it as an expenditure. But the practices and actually, if you read 99% of the reports, I'm saying 99 because I just don't want to say 100%, you won't find such kind of an adjustment anywhere. Because what stand people have been taking is, you project that much of revenue that you can generate from the current level of brand you have. You don't go on to project revenues with brand building exercise, doing a lot of marketing expenditure, and then arrive at a valuation. Because in PPA, the standards strictly say that value as is, varies basis. So whatever you have as on today. So practically that's the stand being taken. But yes, if you read in theory, there have been articles from few professors stating that you can go on to adjust the marketing expenditure.
Understood.
Brand maintenance expenditure.
So that is so again, what is being referred to is, first of all, it's a very minuscule point, and what assumption is ideally taken is this 4% royalty rate. This is net of all this maintenance kind of an expenditure. So that's why you don't adjust the maintenance expenditure.
So if there are some brand building expenses, you will further reduce it from relief from royalty, sir?
Yeah, that's what we discussed on the brand building part, that practically you will not find it in any kind of a report, because what is being asked as a or exercise is, you project revenues only which you think your current level of brand can create in future.
Yeah, that I could understand. But if in a very exclusive case, if that is to be considered, we will reduce it further from the second line, that is the 20, 34, 45 line.
So yeah, 2034, whatever is then left out, you then adjust it for taxes and arrive at the present.
Thank you.
Pruthvi, just another challenge what I face is to justify the useful life for a mature brand. When you talk about Apple or TCS, it's pretty easier. But for a new age startup, for a B2C business, how do you come up with collaborative evidence to justify, for example, 5 years, 10 years? So what thought process goes behind that? Can you highlight some points?
So see, if you are just referring from a practical report writing, and ultimately this is for a justification to the client and auditors, right? So one of the best backup is to show that since how many years your brand has been in existence. So you say 5-10 years it has been in existence, or I am taking a 5-10 year more life. It's pretty much normal as a cycle, a 15-20 year cycle for a company. If you want a stronger argument to say, if you are taking, say, for a startup, if you are taking a 10-year or a 15-year life, which is a longer period life for a startup entity, you need to find out similar transactions again. Okay, go to SEC filings. And why I'm saying SEC, because only US company report PPA exercises in very detail, where they give allocation for each of their assets. They report their life also. Right, that's why we have to refer only US company SEC. Try to find a similar stage startup, okay, and then ultimately show the company auditors, see, there has been a precedence where a 15-year life is being used for a similar stage company, and hence I am also using a similar life. That is a stronger backup that you can show to the client and the company and the auditors.
Understood. Thank you.
With this, my part on the brand section is over. So if you have any questions, we can take it, or we can move to the customer relationship.
Pruthvi, I have one question.
Yes, sir.
So related to that, if we get the comparables who are from, I guess, US or outside India, then those would be earning the royalty in dollar terms, and there would be a country-specific inflation differentiation also. So would we have to make certain adjustment since we are going to make the brand value for the Indian clients?
So doing adjustment in the rates is very difficult and challenging to justify, because it will include a lot of assumptions and of a valuer, which I mean you can't justify in number terms, right? Those assumptions. So the best approach is to select those kind of companies which fall in your stage of operations, right? And then justify it to them. So for example, I'll just tell you, see, US SEC filings don't just cover US entities. I mean, they are companies registered in US but having operations in various geographies. So if you are, say, valuing a company which is in a less, say, the population of the company is very less, and that is directly linked to your business. So try and find companies operating in a lower populated jurisdiction, and take those companies as a benchmark. So you don't have to do any kind of adjustment, because any adjustment you do will lead to question. The only adjustment which you can still justify is, say you are better in qualitative terms to the set you have considered, right? So what you can do is you can go for a percentile approach, where instead of taking a median average, you take a 75th percentile rate, or if you are worse off, you take a 25th percentile rate, royalty rate, and apply that, and you give the factors. That is very much accepted, and you can defend that point. But doing adjustment like 0.5%, 1% up and down is not a preferred route.
Okay. Thank you.
Okay.
Pruthvi, I have a clarification. Can I? Yeah.
Yes, sir.
Whenever you're doing this brand valuation, and let's say if a company has more than one brand, and we are doing a valuation for a specific brand, so they will provide us with the projections. So from a valuer's perspective, any specific due diligence which we should do to understand the projections, or any specific challenges you have come across?
See, if we just fall back to the valuation methodology, the only critical part we need from them is the revenue, right? And for a company, it is pretty simpler, and that database they will definitely have, that from which section of the brand they are earning how much of a revenue. So no detailed due diligence is required in that aspect. And our exercise, see, if you are doing a due diligence exercise, then it's altogether different thing. But at least what we need to just take a comfort is we need to ask for their historical 3 years, 5 years data, segregating the revenues between both the brands, and see to it there is some kind of a consistency, and in case of variation, the reasons for that in the projected period. That's the only basic check is required for this, but otherwise, from a methodology perspective, that's pretty simpler.
Understood. Thank you. That's clear.
Sorry, just 1 second.
Mr. Pruthvi. Hello. Mr. Pruthvi.
Yeah, Pruthvi will come back 1 minute.
Mr. Pruthvi.
Chandrasekhar, 1 minute. Pruthvi will come back. Yeah. Before Pruthvi comes, okay, this is Subbarao. Yeah, Pruthvi. Please go ahead.
Mr. Pruthvi, about this brand value calculation,
Yes.
whatever we are finding out relief from royalty method, we are taking the royalty based on the certain standards. Suppose assuming that if both the companies are merging in the same industry, say auto industry, and both are having equal brand. So in such a case, can a transferor company, when we are transferring assets, can we recognize the brand for that? So if so, how do we justify? Because brand is there, but we cannot expect any increase in sales because both are in the same industry.
Yeah, so that will, sir, ultimately depend on the use of brand, that whether they propose to use both the brands going forward, or they are planning to merge and use one and single brand, right? So if the plan is to continue both the type of brands as is going forward, then we need to value both of them. And if
assuming 1 minute, assuming that if a A is getting merged to the B company limited, so B company is a retaining entity. So if a B company is not using a brand of A, then we cannot recognize the brand value, no?
Correct. Then we cannot recognize, because see, ultimately you have to see that as an acquirer, for what assets I have paid, right? That's what my PPA allocation will reflect. So if I'm not going to use it, I won't recognize it. Sorry, sir, just 1 second. I have to take one more.
Prithvi, just one question. In this slide that you're showing.
Actually, he may not be available.
Okay.
2 minutes.
In one of the seminars, I was told that for PPA, even if you don't want to recognize a brand, you should value the brand. And on day one, when the merger takes place, you should account it in books. And then if they don't want to use that brand, it is written off the next day itself. But for purposes of PPA, that brand has to be valued, is what the presenter had told.
I have the same question. What he's saying is, if a transfer, okay, Pruthvi has come.
Yeah, we'll just take a 5-minute break if that's fine. Yeah, and then continue.
Absolutely fine. Absolutely fine.
Yeah, thank you. I'll just be back in 5-7 minutes here. Okay.
I think that was an interesting question of Vandana. I think you're right. In the case of PPA, essentially what you do is, when the acquirer pays a particular value over and above the identifiable value, he can identify certain intangible assets and allocate some portion there. And whatever is left goes to the goodwill.
Yes.
So, essentially goodwill goes for the goodwill impairment method. Now, either if you have taken over the brand name and then that gets valued, and then immediately you need to probably write off kind of stuff. So that's like an immediate action plan.
That is what the presenter had told.
Because it is not part of the goodwill, because if you're able to, goodwill will take only those values which could not be identified. Since this could be identified, it could not be part of goodwill. So it has to go to intangible.
Yes, sir.
Thank you.
But most of the cases, transferring company retains their identity and transfer company loses its identity in most of the cases. So in such a case, just now we said, unless you use a brand, then you cannot value. Then in such a case, can't we recognize the brand value in the books, sir?
If you want to use the brand, then you should recognize the brand and use it, sir. But if you do not want to continue the use of the brand, then you will write it off.
What I'm saying is, in most of the cases,
Chandrasekhar sir, value of, I mean, this is my limited understanding. Value of the assets is independent whether the person uses it, right? So I see you buy 100 crores worth of stuff and you destroy it. So you write off. But the value of the asset it is not particular to a specific participant, like acquirer, whether you're using it or not. So that is my valuation is about the independently any person who's going to buy or sell, what will be the value. So the value of the brand, if it existed of the target company, that value will remain there. Only thing is, if the person is not using it, in the accounting treatment, he will write it off immediately.
I think, so my point is, if I'm recognizing brand value, then I need to have a identifiable sales as shown in the calculation for next 5 years. Now, when A been transferred to the B company is returning entity. If they're not using a brand of A, but however, they'll be running the business of A. So in such a case, whether recognizing a brand value using this method, RFR method, is it justifiable from the start point of view? Is my question, sir. Ganesh sir?
Sorry, sir. No, sorry, sir. What I meant was any fair market value assessment that you're doing, my understanding was this is independent of the acquirer's value. The value of a brand is independent of what an acquirer is putting in a value. For example, the value of the brand is 100 crores. The acquirer is putting 0 crores for that valuation or 2 crores for that valuation. Value of the brand will only be 100 crores. The rest of the value either it goes as the bargaining purchase or it goes as a goodwill. So it's independent of the acquirer's plan or usage.
Fine, thanks.
That was my understanding.
Even standard is very clear on that. It has to be done from a market participant view.
That was my understanding, Srijan.
Sir, I have one question. Like where I have to value intangible assets, at the same time I have to value their plant and machinery or land and building, trade receivables, short-term loans, everything they want to calculate for balance sheet revaluation purpose. In that case, like how can I value the intangible assets being a software company? Because they have land and building, plant and machinery, and the other trade receivables, and also they have intangible assets. Because they are getting revenues through intangible assets, then how can we value, then the revaluation of assets will go more.
Yes, sir.
Yeah. Pruthvi, I have one different, like, okay, the client wants valuation of these assets for revaluation purpose, balance sheet, accounting purpose. They have intangible assets as well as land and building, plant and machinery, and other current assets like trade receivables, short-term loans.
Okay.
Now, I understand, okay, land and building, I can take market value, plant and machinery, I can take realizable value, land and building also same realizable value. And being a software company, how can I value the intangible assets?
No, sir. So you will have to first identify which intangibles to value. So, for example, for a software company, the most relevant one will be either the technology or the platform that they have created, right?
Yes. It is all software only they have. They want to they want the revaluation of intangible assets. The software.
Say software, right? So, and if you finally determine that software is one of the core assets for which the business, the business is being run for because of that asset being there in the company, then primarily a multi-period excess earning method is one of the methods that we will cover for customer relationship. So that will become the method for valuation, which is based on nothing but the projections of the company ultimately.
See, if I do like that, okay, I will get the enterprise value. But here, the purpose of valuation is not to know the share price or enterprise value, to revalue all assets.
Correct. So
then the assets size will go up. If I value land and building, then plant and machinery, trade receivables, then short-term loans, and as well as intangible assets, the balance sheet will be doubled.
So what value will come, sir, ultimately, that's a different thing. But what I'm saying is not a business valuation exactly. It's not a DCF kind of a model. It's basically to value that specific asset being software technology platform, where you will remove a charge for all the other assets that you have in your balance sheet, land, building, plant, machinery, working capital. So a charge for that will be removed while you are valuing a software or any other intangible asset using excess earnings. So and apart from that, if there are some comparable similar software which you can easily buy from the market, then a replacement cost or a reproduction cost is also one of the methods which you can definitely look into. So first, you have to determine the intangible assets. Secondly, the method of valuation, basis which you will ultimately arrive at a value, right? And
that's what Pruthvi, if I take DCF method for this intangible all excess earning method, then the value will be very high. The balance sheet size will be more. Maybe I need to take.
But correct, sir. If it's your core asset, your primary asset based on which your business is being run, then it will have a higher value, right? It will generate a higher value for.
Or otherwise, I can do DCF method for this intangible assets. Then I can minus those land and building and other assets. Then I can show, because when I'm doing DCF method, I will get the entire value of the company. Then I can.
But sir, there will be something called as goodwill also, right? Which will be there in your business. So a DCF method, when you are doing and just doing a subtraction of these, the goodwill component will be merged in your software valuation itself.
Yes.
So that's why, a specific excess earning method is being provided and which is recognized. And when you do using that methodology, that presumes that goodwill is, already excluded from your valuation.
Okay. Thank you.
Yeah. So sorry, any questions on the brand part, or we can start with the next intangible? I presume we can start with the next one. So customer relationship. So again, what thoughts or what things you can just recollect when you hear customer relationship. And I might just move quickly for this one, considering the time available, so that we can cover the practical questions that you have. So yeah, quickly, anyone, if what things you can recollect from customer relationship.
Is it an access to a database of customers?
So that's customer list, which can be part of customer relationship, correct?
Yeah, so it is the time and effort that would have otherwise gone in identifying the customers. That is what you are actually saving when you have a ready-made list that is available.
Okay, so that is also one of a separate intangible asset recognized. Say if you're not valuing customer relationship, you can value a customer list with the database that you have.
So something similar to when Walmart bought Flipkart. So whatever customers Flipkart had, eventually they were now customers of Walmart also, like at least in India. That can be termed as a customer list. Am I correct?
Yeah, that can be termed as a customer list, sir. Definitely.
Database. Yeah.
Yes.
What is the difference between customer list and customer relationship?
Is it the contract?
Not necessarily a contract. Very technically speaking, customer list is that you just have a list or a database, which you can, just need not be something which you have created. It is a database which you can buy out from any other party also, that this is the list of customers. This is all their contact details, and a lot of artificial intelligence covers their behavior pattern, etc. So that is a database, that is a list.
Relationship can go even beyond the length of a contract, because there might be a history of the customers renewing their contracts after the expiry. So relationship is something far more long term, but it has to be established on the basis of historical facts and data. That, for example, if maybe in the business to B2B context, if the customer has a history, if the organization has a history of providing services to some of its long-standing customers, and these contracts have been renewed from time to time, with that data, one can establish a value for customer relationship in those cases.
Yeah, I think that's a good point.
I think the core part you have covered is the history of it, right? The recurringness of a customer, whether he's coming to us on a recurring basis. And that's what forms the core basis of customer relationship.
Basically, the repeat business and the tenure life cycle of the customer relationship. Average, how long he stays with you?
So if he's coming just for 1 year, we have a 2-year history, then the relationship is not on that stronger path. And if it's versus a customer of a 10 years, pretty fair. So when to recognize, as you have already answered in in different ways, is if we have a history of recurring customers which have been keeping on coming and giving business to us, that's where you can reliably say that you have a customer relationship as an intangible asset, right? There need not be a contract attached to it that this customer will buy X goods from me for next 5 years. That is not a necessity. It is just that they have been doing business with us consistently since last X years. So that's where you recognize customer relationship. Okay, methods of valuation. As we've been telling, excess earnings is the primary and core methods which you will use for customer relationship. Now the challenge with excess earnings is if you have multiple assets and if you believe excess earnings can be used for more than one asset, in such a scenario, you will be in a fix and you will have to ultimately decide that which is the core primary asset for your business for which excess earnings should be used. Because this can be used only for one asset at a time. Now, except in few cases is where, say, customer relationship generally refers to our existing customers, basically customers that we already have in the past or at current. But you have another intangible, say business partnership, for example, right? Where you are getting referrals for your future customers from someone and you have a contract from them. Okay. So these are two separate intangible assets, one related to the existing historical customers and one relating to only your future and new customers. Okay, not existing. In that case, you can use a meme method for both of these assets because nothing is interlinked. Okay, you don't need the historical customers to service your future ones or vice versa. That's where you can use meme for more than one asset, but otherwise this method can be used only for one asset in practice. And why so? We will just, when we are doing the actual model, we are so going through the model, you will realize why we can use for only one asset. So for this, I will just start with the model and we will take each line item, which is critical to this and discuss it rather than, going pointer wise. So the first thing that we have to, calculate is how to attribute revenue to the existing customers for the projected period, right? So there are some key assumptions. I will just directly go to the Excel file so that it's easy for us to understand. Let me know if you are able to see the file.
I can see that.
Yes,
Okay.
yes, we can see.
So the starting point for this is, if we are, say, as on 31st March 2022 and trying to value this, you look last 1 year, what's the revenue that you have been earning from your existing set of customers. So that is a factual data available. So say, for example, I've taken here 100. Okay. You calculate the attrition rate, which we will just come to how this is calculated, say 25%. And this third point is an assumption that henceforth in future, what's the kind of growth that you are expecting from your existing customers. So generally we take, an assumption of a price inflation and some volume growth. So 5%, 2%, 3%. Or there is one more assumption which is used in the industry is to take the growth rate of your revenues projected for business purpose. So to say that, your existing revenue will also give you growth like you are projecting for your business going forward. So these both assumptions are pretty much valid and are used, in practice quite a lot. So right now I have just assumed, say, a 5% growth from my existing customers going forward. So my FY23 revenue will be, this is a simple calculation of 100 into 1 minus 25 because this is the attrition rate, and into 1 plus 5%, this is the growth rate. And that's how you basically would project your future revenues. Sorry, just yeah, sorry guys for the interruption. So this is how the revenue is being calculated, and next year will be using FY23 as a base into 1 minus attrition into 1 plus growth. So this is how you keep on calculating the revenue. Now the life, okay, when do you stop? 5 years, 10 years? This will be an indication that your attrition rate will give you. So if you are basically, reducing your customers 25% WDV on a year-on-year basis, roughly the life could be 4 years, 5 years, or maximum 6 years. And ultimately, how you have to take a decision is your discounted cash flow till they are becoming negligible is when you can take a life of customer relationship. So here it is almost gone sub 1. So this is where I have stopped. And a 5-year life is logical because 25% depreciation will ultimately lead to a 4 to 5 year life for my customers. So this is the life assumption that you take. Yeah, any questions on this front? Or we can go to the attrition rate.
So attrition rate is what actually?
So attrition rate is how much of the customer's revenue you will keep losing on a year-on-year basis. Basically, how many customers that you have today will not be there next year and year after that and year after that.
It is totally on assumption basis, na? 25
Yeah, I will show you one of the examples or methods as to how to calculate this.
This, I suppose, will be eventually provided by the client, right? In terms of
attrition rate, sir?
Yeah.
No, I am just coming to that example.
Okay.
So let me just
Sorry.
jump to that example. Okay.
Sure.
So this is the data that we need from the client to calculate the attrition rate, which is, this is the list of their customer, how much of the revenue they have been earning from the customer for last 4, 5, how much ever, 5 to 6 years information we can get from the client. So this is a factual data that almost all the clients definitely maintain in their system. Now, what we have to calculate is, say, customer, what amount of revenue loss has been there on a year-on-year basis from the customers. So this customer A, 20, 25, 40, there is no loss, it's always increasing. But from 40, it went down to 25. So there is a 15 loss of revenue. 10 going down to 0, so 10 loss. Even if the customer is coming back after 4 years, does not matter because next year it is not giving us any revenue. And this attrition rate, we are applying on a year-on-year basis. So what you do is you calculate the loss of revenue from your customers on a yearly basis, take a sum of that. So what does this mean? This 60 total revenue which was coming from these customers, out of that 20 is lost in the next year. New customers have been added, but from existing customers, 20 revenue is lost. So this 20 divided by 60, 33% is your attrition. Likewise, you calculate for each year, FY20, 21, 22, right? What is the loss? And then, you can decide if there is a trend, reducing trend, increasing trend. You take a trend based latest year or you take a average. This is one of the methods how you can calculate your attrition rate. Yeah, sorry.
So one basic question. So is customer attrition about same customer spending less than before, or is it totally losing the customer altogether?
Both of them. Both of them
are there. Okay.
Yes, because if that customer is giving us lesser revenue, that is also a loss to us, right? Because what we are starting is this 100 set of customer we have today. If it's going less, then that is also an attrition loss for us.
Okay.
It's
but
the
there could be
only
many
business
factors
thing
here at play, right?
Sorry, can you repeat the question?
What I'm saying that if you also want to include that existing customers are spending less on your product, right?
Yes.
But the customer is still there with you.
Correct. But
Right.
ultimately,
If you define that also as attrition,
yeah,
then we have to be very careful, very sure about the data that is behind it, right? Maybe some price reductions have happened. Your product mix, all those things, right? Maybe he's buying more of your low priced products than so his mix is changing. So that is also many factors are getting mixed up here, right? So attrition you're saying is just not the case of a customer no longer buying with you. He's there, but he's buying less from you.
Yes.
That is also part of it. Okay.
Yeah, right now we are looking at only a 6 customer set, right? But we will get a data for 100, 200 customers. Now there will be few exceptions like you mentioned, but in the overall average median that will be covered up, right?
Okay.
So we are looking at a very holistic kind of a approach that to give us an indication of the attrition rate.
Okay.
Do we need to segregate price and number, which is number of customers or quantity, or we can take it together and make an average estimate?
Yeah, these are the revenue numbers, and generally we take on a total basis. Now, if you are aware of a specific exception, where the company has reduced their pricing in a specific year, and because of that there has been a change, a substantial gap, then the approach is to just exclude that year. So if FY21 the company announced a price reduction because of which you are seeing, say for example, 50% attrition, so you can ignore this as an entire period as an exception.
Yeah, but they could also be more complicated, like mix, like for example, right? You're selling larger packs and medium packs and smaller packs and something. The customer is from premium prices is going to less premium products or something. That could also be the case, right?
So if there are pointers which are on an ongoing basis keep happening in a company, that points you don't need to bother, right? Because in future also it will keep on happening, and then your attrition calculation will cover this cycle of changes. But if any specific one-time kind of a price reduction event has happened, then that part you need to just be careful of.
Okay. Okay. I had one more question. The previous, the main slide, that the other sheet that you're showing, right? So, so here what you're saying is, in the Excel itself, the first tab that you had shown.
Okay.
So, yeah, this one, right? Not this. Yeah. Okay, here only. So you are in FY24, you could be making some new customers also.
Yes.
Right. And they would be giving you some repeats. As your customer relationship doesn't work on just your existing base of customers, but it could work on your new customers that will be making in 24 and 25 also, right? So I see that in your calculation that has not been factored in. So it is like as on given date, this is your bunch of customers that you have, and you're valuing the relationship of those customers alone.
Yes, sir. Because if we start taking new customers, then it's nothing but we are valuing the business, right? Because few customers will go, new customers will come. What we are valuing intangible, my existing customers, what they will give me in future. That is my customer relationship value.
Yeah, this could be applicable if I'm buying a particular company and want to value the existing customer relations as on the given date when I'm purchasing it. Right.
Correct. So now let's continue on the Excel also, because it's easy to understand. These are the margins. So in margins, you have two options. If the company is able to provide you customer-wise margins that they are earning, you can take a weighted average of that and apply that going forward. But if that is not available, you can assume that overall what the business is going to earn, that will be charged to your customers also. So you arrive at the EBITDA from existing customers. Now coming to depreciation. So in business valuation, we take depreciation as a non-cash adjustment and we add it back. In case of customer relationship or a meme method, basically, there is a concept of return on asset and return of asset. Okay, so I'll just explain you the concept and then this will be very easy for you all to understand. So return of asset, as the word says, is if you have invested your money in any kind of an asset that is helping you to run the business and earn your revenue, that return, a depreciated amount of that return, you need to recover, right? So while I am earning 15.8, right now I am valuing customer relationship as my intangible asset. But there are some tangible assets in my book which are helping me to earn this kind of a revenue. So this is the return of asset. I have invested, say for example, I had this net blog only. I have invested some 17 million in the tangible assets. Then I need to recover that amount. So in case of this valuation methodology, depreciation is not added back subsequently. It is just reduced as a return of asset, basically the amount that I have invested in the business in other assets. So that's how you basically get the EBIT. You reduce the taxes, and here you don't have to look if you have any brought forward losses, etc. This is just an intangible asset valuation that you are doing, not for any business or a going concern entity. So just reduce on a flat basis the taxes. You arrive at the operating profits post tax from existing customers. Now comes the concept of return on asset. So this 17 million you invested in tangible asset, there is always we have heard the concept of alternate investment. So if I did not invest that money here, I would have invested somewhere else. That return I am losing because I have put this money in my business. So the amount of loss, basically, or basically the return that I would have earned by investing this money somewhere else, that is return of asset, that needs to be reduced for each and every asset we have in our balance sheet, except customer relationship, because we are valuing customer relationship here. So I am using working capital, some amount of, some of my funds are blocked in working capital perpetually. So I need to reduce the charge for that. I will just come to how this charge is calculated. Similarly, fixed assets charge is to be reduced. Assembled workforce. Now, when I'm acquiring a business, all of the businesses have a set, trained and skilled workforce with them, right? Assembled workforce, again, this will take a more detailed session to explain you how to value and all. But assembled workforce is not allowed to be recognized as a separate intangible assets in a PPA exercise because you can't control your workforce. Right? So a standard do not allow you to value this or recognize this separately. But because you have a workforce, you are able to earn your revenues in a more efficient, better, and you are able to grow your business. So a charge for that has to be reduced when you are valuing other intangible assets, right?
So when you are arriving at a charge for this, is it the replacement cost that you are considering?
So the assemble, if very quickly I just explain you the most easiest and most used method for assembled workforce. What we take here is, if we have a set workforce which we have acquired along with the business, now to create that kind of a workforce, I will have to spend a HR cost, basically hiring cost, that I have to pay to some HR consultancy, which is generally 1 month of salary. Once that workforce is joined, I need to train them. So say, for example, we assume 1 month goes in training. Once they start their job, there will be some loss of efficiency, right? They won't be at 100% efficiency since day one. So we assume, say, 1 month goes in there, getting them efficient. So 3 months, I have a loss of the salary that I'm paying to the workforce. So whatever is your annual salary expenses, okay, say 5 crore, 3 months, so 5 crore into 3 divided by 12. That is the simplest way and it's the most used way of valuing assembled workforce. That if you had to recreate this, that's how you value the assembled workforce.
Pruthvi, one clarification. You are reducing the depreciation because that is a return on assets. Correct. Whereas you are adding this, reducing a contributory asset charge on fixed assets also. Is there a duplication? I mean, if I'm not sure, because there's a fixed assets will, yeah.
sir, I have fixed assets. So I'll just go to the example what I have created here once. Say I have fixed assets of 120, right? This is my big, sorry, this is not of say 8.4 at the beginning. So fixed assets of 8.4. This is the money I have put in the intangible assets. Sorry, fixed assets, right? So by depreciation, I am recovering this money. Okay. And this is nothing but if I'm not doing this business, if I'm not running on the business, this 8.4 I could have invested anywhere else and earned a return on it, right? I'm blocking that funds. I'm either taken a loan from bank and put up this money. So I am paying that interest to the loan, interest to the bank for this 8.4.
That's double counting, right, Pruthvi?
Why,
Exactly.
See, either you say you will do an opportunity cost,
sir?
or you say the indirectly by reducing
Alternative.
you are considering that opportunity cost. You cannot have both at the same time. So only other way to look at it, depreciation you have considered the principal component, and in the contributory charges you have only considered the interest component.
Yeah, that's how it is. That's so I'll come to the calculation, but that is how it is. This is only the return I will earn on 8.4. This does not include 8.4 base amount. So this
reduce the amount of the first year when you did the depreciation, the next year's interest calculation have you reduced for the remaining portion? Is that how it is?
I didn't get. So let me just jump on to the fixed asset calculation, and then you can ask me that question. This is my fixed assets requirement, and this is the net block basically of every year. Okay, these are the assumptions. So let's not discuss on how the number has been arrived. Say this is the net block requirement of fixed assets for every year. This captures the additions, the depreciations, everything required to run the business. Now, I'm assuming 11% is my return. We will come to how the return has been calculated, but 11% is the return that ideally a fixed assets of the company will give it to me. So 8.4 into 11%. This is basically something that I am expecting my fixed assets to return, or a loss of my opportunity cost. So this is the amount that I am trying to recover in my contributory asset charge. Okay. Now how? First of all, that basic question of double counting, whether it is still there or this is clarified.
It's not there. Double counting is not there.
Okay, great. So now how that charge is being calculated, we will come to that. So this is the revenue that, say, at a company level, okay, at the business level we are earning. This is the projected revenue. This is the charge for fixed asset, basically return on fixed assets that I want to earn. So I am calculating the return as a percentage of revenue because ultimately I have to apply it only to my existing customers' revenue. So this is the percentage. I take an average of it. So a charge for fixed assets is 0.7% of my revenue. So what I am doing here, 0.7 into revenue attributable to only existing customers. This is the return that I would need for investment I have done in my fixed assets. Okay, only the return part of it. Now, so clear up till now?
Yeah, this is helpful. Thank you.
Only thing is the principle that you are subtracting. Is that also applicable only to the existing customers? Are we saying that the total 17 is attributable to the existing customers?
Yes, sir.
This calculation?
Yes, sir. This also you have to take it as a percentage of revenue only. So whatever is your depreciation for the full period, you calculate as a percentage of revenue and you apply that same percentage here on existing customers. This will be only amount attributable to the existing customer.
Okay, thank you.
Okay. So the charge is calculated in a similar manner. I will just come to how the return percentages, why they are different for each and how we should assume that return percentage. Now, when coming to working capital, the return expectation for working capital will be pretty similar to the cost of debt of the company. So generally, you will fund your working capital using a bank OD. Now, all this assumption you have to consider from a market participant perspective. Though your company might be funded 100% from equity, 50-50, doesn't matter. This is basically how much is the riskiness of this asset, and based on that we have to consider the return. So working capital, generally banks say give only 75% OD for working capital. So you can assume a 75% debt, 25% equity ratio, and arrive at the cost of return for working capital. Or if you think 90% is allowed, 100% is, you can take debt. Whatever is the standard industry assumption, you can use that debt equity ratio and arrive at the return for working capital. Right now, what I'm linked to is the cost of debt. These are my basic assumption. This is the cost of debt, cost of equity. So this is the return of working capital. This is my working capital requirement. I multiply it. This is the return that I should get, and that I calculate as a percentage of revenue. Similarly, for fixed assets, what I have assumed is fixed assets company will fund using a 50-50% debt equity ratio. Okay, so generally that is the basic industry assumption that we take. Now this either you can link to your WACC also, that is also pretty much okay, because you will say I will fund the fixed assets using my WACC ratio. So that is also an accepted assumption. So that will determine the return for fixed assets. Assemble workforce being an intangible, again we need to take a return which is either equal to the cost of equity or higher than that. So right now I have equaled it to the cost of equity. So this is how we will calculate the return percentages for each of the assets which are being used. Now, for example, if say there is a software or a technology which is being used in the business, we value that software, we take that charge here also. So all of these assets which are used to generate revenue from existing customers will be reduced here. Clear till now? So we can go ahead.
Can I ask one question? And this is not specific to only intangible assets.
Sure.
Mostly in a working capital case, because you are doing a VARA, right? Weighted for each asset. Working capital, you normally don't get funding at all without a collateral. You don't get funding without a collateral. Now, collateral is as good as they say that you either put a cash deposit or you give a collateral of 2 times real of that value, whatever. Which is, in other words, is nothing but your opportunity cost of that particular asset. So, should we include that cost also? Because here 7% is essentially what they lend, but the terms is essentially including a cash deposit or including a real estate, where the opportunity cost is there. Should we consider that in the cost of working capital?
So just to answer a question in a very simpler manner, if any additional funds are being blocked, so say you need to keep an OD with the bank, FD with the bank. The cost that, and if it's interest free, okay, they are not going to pay interest. Then you add that amount here, that is your blockage basically, and then compute that charge on the working capital. So simple answer is, if any additional funds are being blocked for getting a loan, then that has to be considered in the working capital charge.
Thank you.
Yes. So now after reducing this charge, whatever amount is left out, that is the amount that you will attribute to the customer relationship. You use the discounting factor, arrive at the present value, add the tax amortization benefit, and this is how you arrive at the value of customer relationship. Now this is what is called a meme method, and any asset, intangible asset that you want to value with meme method, the approach remains standard. The concept of CAC, reducing depreciation, these all remain a very standard approach. And we'll just move on to the presentation. Yes. So we've covered the charge also. And again, just a simple report format of showing importance of customer relationship, life approach, and the steps in the meme method. So yes, sir. Any questions on customer relationship or the methodology, meme perspective?
Should we reduce any customer retention costs as such? to retain the existing customer, if there are any expense, like you may run a scheme of giving discount credit points to them. So should we factor in that, or it is assumed it is the net revenue takes care of that?
So here, if you see, sir, we are taking EBITDA as a starting point, right? Revenue and then EBITDA. So if there is something which you have been already giving it to them, then that EBITDA will definitely cover it, right?
Cover it. Okay. Thank you.
Okay.
Okay.
Yes, sir.
Related to that EBITDA, so do we have to use the EBITDA specific to this because for this customers we are not going to incur the S&D like we are going to incur for the new customers. So is it we need to use adjusted EBITDA for these customers?
So pretty interesting question, and great you asked it. So there is one adjustment which is allowed per se, is to add back any selling marketing expense that you think, or based on, of course, discussion with the client, that might not be incurred for your existing customers. So this EBITDA is after reduction of your selling marketing expenses. Now, if basis your client discussion, they are of the view that we don't need to incur the same kind of an expenses for the existing customers, you can add it back and increase your profit. Now, generally what we do is we look at the historical trend of marketing expenses incurred and use that, just to justify what range of percentage we can add back. So, if the management is saying you add back 5%, we won't just do it in that manner. Just look at the historical, how much they have been spending, and accordingly we take a call.
Okay.
So this is what basically these two key intangible assets are all about. And while there are many other assets, few other methods also, maybe some other session we will definitely cover it. But few key things, while you will be doing constantly PPA exercises, which I have seen are very crucial, is one is the tax amortization benefit, which you need to consider, and this is not a compulsion, it has to be on a case-to-case basis. So if you are valuing for any geography where there is no benefit on intangible assets, tax benefit, then you should not add it. So it's a case-to-case basis that you need to consider. WAC VARA IRR reconciliation is very crucial for the PPA exercise. These are all very detailed topics, so I won't be able to cover it in our discussion. But yeah, as a practice, I think this is what we need to definitely look at. And the last very crucial thing, which I have not seen in very less reports, but a very qualitative input, is again goodwill benchmarking. So ultimately, whatever goodwill is arrived, it's say, I'll just go back to the first slide. So in this case, it's 20 upon 100. So 20% of my consideration is goodwill. Now, we need to have a benchmark that the industry in which this company is, the past PPAs that have happened in this industry, what has been the goodwill percentages in those PPAs. And once you show that range and your answer is within that range, that is a very strong backup of your ultimate exercise, and then your validity of your exercise very much increases. Again, for goodwill benchmarking, there are few bigger groups in India which give data of PPA. Like for example, HUL did some acquisition, so they showed how they have recorded all intangible assets. So again, India perspective, this data availability is limited, and we need to again those US companies SEC filings, and this is a very easily available data in those annual reports. Yeah, sir, that is it. Any specific other questions that we have, we can take it, and that's it.
We just wanted to.
Mr. Pruthvi.
Yes, sir.
Other than this brand and the customer relationship with customer, what are the other intangible assets we can recognize?
So, sir, definitely very business specific. But if you ask me, in my experience, what have been the different kind of assets? Its distribution network is one of the assets that, if we have a network of distributors, we can value that. Vendor contracts, if we have a contract from any supplier to supply their product in a specific geography, okay, then that is a key contract to our business. So vendor contracts are valued. Non-compete is one of the asset which is there in almost all kind of transactions, right? So non-compete is an asset that we can value. These are the most recurring assets that I have seen in a PP exercise. And then
one question.
An IT company, sorry, last point, then technology, software, or a platform. And if it's a very technical company of some formulation modules, then the process or the patents can be valued.
Pruthvi, one question.
Yes, sir.
Is it always that the purchaser has to go through this PPA? Let's say in the US context, for example, for the IRS, the buyer and the seller agree and fill up something called Form 8594 or something, right? Where they come to an agreement that, I am selling this business to you for this amount, but within this, let us agree that this asset is worth so much, this asset is worth so much, because both of them might have to independently file this Form 8594 with the IRS, right? So is there a situation where the seller should also have to perform a PPA?
So
is it required?
So if we look at the specific from a books of accounts perspective, from seller perspective, it is going off, right? So there is
it's not required, correct? Yeah.
Yeah, it's not required from a seller perspective.
But from an IRS perspective, something, because at the end of the day, the buyer and the seller have to agree and fill up jointly, I think, some Form 8594 or something where they have to say that for that purpose. Would the seller, have you seen any scenario where the seller is doing a PPA?
No, sir. No scenario where a seller is doing. They would be asking us to value intangible assets on a separate basis for any reporting purpose. But a PPA exercise kind of has not been asked from a seller.
Okay, so what you're saying is there are situations where even the seller would be required to value intangible assets after it's sold, after a sale has happened, right?
For sale, for the transaction.
For sale. Okay. Thanks. Yeah. But the principles and methods, everything would remain exactly the same, right? No difference.
Correct. So these are, specific methods for intangible, which are a little different than our traditional business valuation methods.
Right. But what I'm saying is, if a seller is required to sell,
whether you are doing PPA, you are doing for any other purpose, intangible assets, same method.
Okay.
Yeah, Pruthvi, I have just two questions. So, for listed company or for unlisted company, for doing this PPA, is there any specific requirement that only registered valuer can do it, or any CA can do this?
No, sir, there is no regulatory requirement from that perspective mentioned. But the challenge is, see, this falls ultimately for financial reporting purpose, right? And then that purview is very much linked to Companies Act because you are doing for reporting purpose. So I have seen almost all companies requiring a registered valuer to do this exercise. But there have been few groups, even larger groups, who have taken reports from our consultancy arm. So though legally there is no XYZ return and they have done both. But if you ask me, because this comes under the financial reporting purview, our RV report will be beneficial from a client perspective.
Okay. And regarding to the brand valuation, so somewhere, for example, if somebody has disputed that brand and the brand is already at a, like somebody has put a claim that I also have similar kind of a trademark or IP, then for that particular PPA, how do can we really do the valuation, or we just have to ignore
Yes, sir.
that?
So practically, sir, you definitely do the valuation. And of course, we have to disclose it because these are matter of legal nature, right? We as a valuer cannot take call on those aspects. So you value it, you show the value and disclose it very clearly and upfrontly that these are the matters going on. We have valued it, assuming the client owns the brand.
Okay, got it. Thank you.
Pruthvi, just wanted your view on a tab benefit for customer relationship, because there have been difference of opinion among the auditors what we have dealt with. So how do you consider or you don't consider tab benefit for customer relationship?
We will consider, sir, because this is an income approach, and nowhere in our methodology any kind of a taxation kind of a asset is getting captured. In fact, we are reducing the taxes, right, from a profitability perspective. The scenarios where tab is not considered is, say, if you are using a comparable transaction, okay, so basically a similar asset, if we have to reproduction replacement cost method, right, where if we can buy similar asset in the market. So in that scenario, if we can buy it for 100 rupees, 100 is the value. You cannot add a tab to it because entire value is being agreed on that 100 thing, right? So only in those kind of a scenario where the value is a market denominated based valuation, tab cannot be added. But otherwise, we have been taken it, and we've dealt with almost a lot of big fours also. No debates on that.
Understood. Thank you.
Friends, we can take maximum one more question. Yeah. On behalf of Bangalore Valuers Association, I request Mr. Ganesh Ramani to extend a formal vote of thanks.
Thanks, Shilpa. I think I always say, as the name suggests, intangible asset, it's the most dreadful topic for anyone even to talk about it. And it's for the speaker in front of the audience to talk about this subject is a nightmare, because while valuation itself has enough amount of subjectivity, intangible assets is a multifold in that aspect. And the way Mr. Pruthvi has started and actually tried to put in his thoughts clearly in terms of the workings, in terms of the databases, in terms of how he approaches, in terms of giving clarity on how to look at the B2C and the B2B. Even the interesting way of he talked about the perpetual life and the limited life, very interesting, and that only emanates because of his effort and experience in this particular subject. As an audience, I can say this subject, while I have attended multiple times intangible assets topic, never ever an audience goes completely satisfied with this. It is nothing to do with the speaker, it's related to the topic. And the topic is like that. And every speaker who comes and does on this particular topic, it means there's a lot that is to be attributed to that particular speaker in terms of his capability. Thank you, Mr. Pruthvi. You did a wonderful job. And I think you have a lot of patience in terms of handling a lot of questions, a variety and a range of questions. And there's no limit because this can go on and on. And on behalf of BBA, I would like to thank you for your effort. And we look forward to learning many more on this and probably much more detail on each of these topics, as you have been telling, in terms of going into detail aspect. And we look forward to hearing from you again. Thank you.
Thank you very much, sir, for your kind words, and you have been wonderful audience also. I was little stressed as to it should not be monotonous and monologue, but you've been wonderful in that. Thank you very much.
Over to you, Shilpa.
I thank all the BVA members for your patient listening and making this program successful. I wish you a Merry Christmas. I wish you a very Merry Christmas in advance. Over to you, Subbarao.
Good evening, everyone. I hope maybe we can conduct in future Friday also. Now, just I want to know that the members' opinion. What about Friday instead of Monday morning? Because I can see that compared to Saturday, Friday the N2 and the activeness from the members. What do you say, sir, Ganesh sir?
I'm not a big fan of Friday evening. I think maybe probably a Sunday would be better. I understood Saturday morning is a struggle. Probably we should shift to a Sunday is what I recommended, but I might be the odd person out. Two reasons. Friday evening, with all the hectic work, we may not have completed by evening time. Secondly, like Saturday mornings, definitely for certain regions where it is very cold, it may not be comfortable. And Saturday evenings could be a evening family get-together time. So if I rule out all these things, I think I don't know whether I'm the odd man out, but Sundays is something we can look at it an hour or 2 hours, maybe.
Sunday is
but
very odd, sir. Sunday is very odd. Now I request any other members, okay, can express their opinion about Friday, whether having sessions on Friday 6 to 8. Maybe other members like Vandana and also
any working day in the evening is okay, because one day or one day the other you are engaged in the profession, so you can add. Otherwise, on the weekends we need to have the other things also. So any working day in the evening.
Mr. Pruthvi, 1 minute. On behalf of Bangalore Valuers Association, we would like to present this memento to you. It will be couriered to you. Our admin will be in touch with you.
So thank you very much.
Yeah, thank you so much.
Yes. Any other opinions, any other views on Friday from the members? Mr. Senthil, thank you, Harish, Vandana, Subarayudu, Rajendra. Then we want to take your opinion.
Sir, if you want to take it on a weekend, make it on a Sunday. Because after the hectic week, rising up so early on a Saturday morning is again very punishing. At least 1 day a week you have to allow us to rise at our convenience that are later. No, make it so give one gap, and then if you want to make it on a Sunday morning, that should be fine.
Sunday, I think okay. Maybe some people okay, it's rule out, sir, because holiday, a lot of people will go on trips or okay, on family functions, family get-togethers. Maybe we can think only Friday, Saturday. Well, few members.
Then Saturday, maybe we can make it a little more later. Maybe 7:30 in the morning is little early. Maybe 8:30 or something like that.
So 8:30.
I mean, this is my opinion, of course. Others are most welcome to.
Sir, what happens, sir? By 9:30, 10 o'clock, like CSES Institute will conduct some sessions like CPA.
Okay.
Professionals again, okay, like again, physical sessions also will be there. Again, it will be a problem if you.
Sure. Yeah, okay. That's just a viewpoint. I mean, we'll take everybody's viewpoint and then decide. Thank you.
Thank you everyone for your opinion, and great weekend ahead and holidays.